Hi guys, welcome to Chapter 6, Analyzing Cash Flow and Other Financial Information. So the next couple chapters that we're going to be talking about have a lot to do with finance. And I'm not going to spend a tremendous amount of time on them just because these are things that you learn in your accounting classes. And as I often tell people, in business, you don't necessarily need to know a lot about accounting and finance. You just need to know enough so that you know that whoever you are, the professional you've hired to take care of these things is not taking advantage of you. So let's get going. So the first thing is cash flow. Cash flow is, if you think about it in terms of your own personal life, it's how much money you have, how much actual cash, not credit, not how much cash do you have. If you were to line up all the dollar bills, how much would it be? And it's basically all the cash that comes in versus the cash that goes out. So it's income versus expenses. Income minus expenses, and how much actual cash, as I said, you have left over, not lines of credit, anything like that. And it is not the same as profit because we'll talk about that more. But so anyway, it's really, cash flow is super important to survive in the beginning. So negative cash flow is when you have you're carrying more inventory, and you have more going out than coming in. That's a big problem and something that definitely to be avoided. And cash flow is one of the biggest predictors of business success. So we have a thing called a cash flow analysis, and again, it's really important that you keep on top of that you have your accountant work on that and that kind of thing. Okay, float. Float is the difference between the money when the money goes out and the money comes in. So how much time is there? There might be a little bit of a float. So if they talk about the float in a bank is if you pay a bill, but it might be 3 or 4 days before that bill is cashed, or before that check is cashed, then you still would have access to that money in your account. And so that's sort of like the float. And you want to be careful about playing the float because it can get you into trouble. Okay, so budget's super important. I'm sure you've talked about budgets in your accounting classes, and basically the budget looks at everything that's going to come out, all the expenses you plan, and then how much money is going to be coming in. These are a bunch of examples of different types of financial statements. Cash flow statement. Okay, just to give you an idea. You can look, those are in the book too. All right, so there's the thing called deviation analysis, and deviation analysis is basically what you predicted, the difference between what you predicted and what actually happened. So if you predicted $100,000 in sales and you got $120,000 in sales, the deviation would be $20,000 positive, and then that is going to help you in planning for your next budget. So here you go. So the actual versus the difference. Predicted, in this case, it's an opposite situation. Predicted 6,000 in receipts, but only had 3,350. Okay, so it's really, as I said, it's very important that you develop these cash flows, and you have a budget because it's a path. It's like the business plan. It's a guidepost to help you know how you're doing and that kind of thing. It's super important to keep them up to date. So what are some of the things that you're going to put in a cash flow? These are the things that are expenses, salaries, benefits, utilities, security systems, the basic month-to-month expenses or day-to-day expenses. And then also any other kinds of expenses, travel expenses, cell phones, maintenance, cleaning, all that kind of thing. And then you want to take a look at your revenue. And you want to see like which area is making more money. So for example, if you own a restaurant and you have takeout and you have a bar, which area is making more money? The bar, the sit-down restaurant, or the takeout? So you want to see where's all the different revenue coming from? So you have an idea of which part of the business is doing best and which part of the business needs some help. So here we go. Restaurant cash flow statement. Again, these are all in the book you can take a look at. All right, so sensitivity analysis, also very important. Essentially, it looks at what's the best case scenario and the worst case scenario. And it tells you how much tolerance you have in terms of how much leeway do you have. Do you have a little bit of extra room for maybe more expenses? Or what exactly, how delicate are the finances and in which area? So there's also other financial tools that we use. And again, I'm sure you've talked about a lot of these in your accounting classes. We can talk about them again a little bit here. This is probably, in many ways, probably a little bit of a review for you. Pro forma describes the estimates of what the balance sheets and income statements will look like in the future. So going forward in the next 2 years, this is how we predict the business is going to work. We're going to be paying down all these debts, and one of our big customers is going to be increasing their sales, that kind of thing. So what do things look like down the road? Pro forma, it's an estimation. And then balance sheet is the assets versus liabilities. So there's current assets and fixed assets. Current assets are cash, or those assets that can be easily converted to cash. Those are the most liquid things. Fixed assets are things that are something that's positive on your balance sheet, but are not necessarily cash. They are equipment, real estate, that kind of thing. Vehicles. So they're considered part of your assets, but they're not easily convertible to cash. Okay, and then there's current liabilities and long-term liabilities. Current liabilities are current bills that are due, accounts payable, banknotes, payroll, that kind of thing. Then long-term liabilities are things that are due for more than a year ahead. So mortgages, or stockholder equity, that kind of thing. Okay, so a balance sheet is basically a snapshot of the business at one point in time. It's just it's not what's happened yesterday. It's not what's going to happen tomorrow. It's what's happening at this very moment. So assets minus liabilities should total 0. So here we go. Example of a balance sheet. So predicting performance, it's if you can predict your performance, you can take that literally to the bank or to other creditors to let them know how you're going to be doing, so to help with future financing, that kind of thing. Okay, the next one is the income statement. Income statement is revenue minus expenses, and it basically looks on profit rather than cash flow. Even though I would say cash flow is super important because you need to keep the cash flow going. If you have a lot of money coming through, it means you can pay your bills and that kind of thing. Cash flow and profit, 2 different things. So the income statement is going to show you what's going on with profit. And here we go. Income statements. Give a little example of that. Goes the first 6 months of the year, first 2 quarters. Okay, and then break-even analysis is important for determining pricing. Because as you know from, I would think, marketing class, we talk about this, and also an accounting class, fixed costs are things that have to be paid no matter how many units you produce. Variable costs are things that vary according to how many goods are produced. So let's say you own a bakery, your fixed costs are going to be things like your mortgage, the cost of your, maybe the payment on your equipment, certain salaries, insurance, those kinds of things. Car payments, truck payments if you have deliveries. And variable costs at the bakery are going to be based on how many cupcakes or cookies or cakes or pies or whatever you make. That if you make, the more pies you make, the more fruit and flour you're going to need to buy. The more cakes you make, the more sugar and flour you're going to need, or butter or whatever. So it's important to have that break-even analysis to know exactly how many, when will it that our income exceeds expenses. What are the basic things we need to cover with our fixed costs before we can start to make a profit. You gotta fixed costs also can be considered overhead. You gotta cover your overhead. That's why sometimes you'll see, you might see stores and perhaps in nicer areas have higher prices because they have higher overhead. Anyway, okay, so here we go, break-even diagram. You can see units sold, sales, variable costs, fixed costs. And then it's just a little different take of it. A new venture's net cash flow exceeds the initial investments plus the time value of the money invested. So it's this idea that you're going to have, the first couple of years you're in business, you're probably going to have some expenses that after time you won't have as much of. Okay, and then finally, again, this is, I'm sorry, that's my clock telling you that it is noon. So time value of money, again, net present value, net future value, things that you talk about in finance and accounting. So, as you know, $10 today is not the same as $10 in 1972, and $10 today will not be the same as, $10 in 2032. So because of inflation and money fluctuation and that kind of thing. So you need to know if you have something that is not going to be paid, say, for 10 or 15 years, what will that, even though the payment is, maybe $1,000 now, in 10 years, it's, relatively speaking, that might be less money to what it is today, if that makes sense. Okay, so that's a really quick go through on financial statements, and next we're going to talk about finance and accounting. Okay, thanks guys.